Fitch's Fixed Interest podcast delivers the analyst insights and updates you need to stay ahead in a rapidly evolving market.
Hello and welcome to the latest edition of our Fixed Interests podcast series. I'm Christian Scarafia and I'm the head of Fitch's bank ratings in Northern Europe. Today we are discussing the European Commission's latest push, published in mid-July, to improve the competitiveness of the EU banking sector, and in particular whether it could finally start removing some of the barriers to cross-border consolidation. For this, I'm joined by Robert Mazzuoli, who heads our financial institutions regulatory research. Let's start with the big picture. What is the Commission actually trying to achieve?
At a high level, the Commission is trying to make EU banks more competitive by reducing some of the frictions in the current regulatory framework. This is not a new goal, it is a long-standing objective. One of the biggest points is improving the cross-border fungibility of capital and liquidity within multinational banking groups. This would potentially remove a key obstacle to greater sector consolidation.
And when we say fungibility, we really mean banks being able to move capital and liquidity around their group more efficiently?
Exactly. The Commission is proposing that certain requirements would need to be met at the parent entity only, rather than resulting in excess capital and liquidity being held at subsidiaries. It also wants to harmonize the treatment of intra-group exposures for domestic and cross-border groups. And it is considering using its toolkit to support cross-border mergers and acquisitions to overcome national intervention.
So the rationale is if you reduce trapped capital and liquidity, you potentially make cross-border banking groups easier to run and maybe easier to combine?
That's right. But it is important to be very clear. These proposals could facilitate sector consolidation, not guarantee it. Other obstacles still remain, including differences in insolvency and consumer protection legislation.
So we will not see a fully unified banking market overnight. What about deposit protection? Is the idea of a single EU-wide deposit insurance scheme that had long been seen as a key part of banking union dead?
Yes. The Commission has given up its old proposal, which had met with significant opposition from some member states in the past. Instead, it now plans to simplify the frameworks of the national deposit schemes.
Let's talk about Basel III and lending, another must-watch area for investors.
Yes, the Commission will issue proposals on how to adapt Basel III standards to incentivize more bank lending to certain sectors of the economy. These include SME lending, residential mortgages, project finance, and trade finance. The Commission will also revisit the structure and scope of the Basel III output floor.
So we can expect credit risk to consume less capital going forward. The Commission also plans to simplify the regulatory framework for smaller banks. What is our take on it?
The communication mentions simplifying requirements for small and less complex banks. And we think that this is unlikely to result in materially weaker capitalization, but should help reduce costs and complexity.
So that's a competitiveness point too, in this case for smaller banks having to cope with a sometimes heavy regulatory and supervisory burden. Let's move to a more technical area, the capital stack. What is the Commission proposing here?
The Commission is looking at simplifying the various capital stacks across the risk-based, leverage, and resolution frameworks. For example, the MREL framework could move closer to the TLAC standard, and some buffers could be merged or harmonized to improve their usability. While simplification could reduce complexity, we do not think that by itself the usability of releasable buffers in times of stress would improve. Banks may still be reluctant to eat into the buffers to support lending due to the limited size, potential stigma around using them, and the need to rebuild them afterwards.
And finally, we need to mention one thing that has not been included in the Commission's paper.
You're alluding to AT1 instruments. Indeed, in contrast to the ECB's proposal of late last year, at this stage the Commission is not proposing to reform the AT1 capital framework to improve that instrument's loss absorption capacity.
Interesting. So this case is off the table for now, but I'm sure we will revisit all these topics again in early 2027 when the detailed consultation will be launched. Robert, thank you for taking us through the Commission's proposal, and thank you to everyone for listening in. We hope you will join us for the next edition of Fixed Interests.
Subscribe to Fixed Interests wherever you get your podcasts.